Hey guys, today we're going to talk about Trading212's investment pie feature and why on some cases they don't work well. Before I get into this is just my opinion and not financial advice. First of all, pies are a great way to invest in a preset list of stocks per month in an exact allocation. Before this feature was launched, people would have had to go in and buy those stocks each month on a manual basis. After Trading212 launched this feature, thousands upon thousands of people went ahead and actually created their own pies and published their pies to the pie library. Ultimately, people were allowed and are allowed to copy other people's pies. At first, this sounds like a great feature, but there are certain things people are overlooking and which may become quite costly for them in terms of their investments. The first thing is that pies don't actually update automatically. This means that if a person has a sort of strategy behind a pie, they've created a list of stocks which they believe in, but as things do in the stock market, things change across time. Now, he might update his pie, but you might have the old version. It goes back to the process of even if you know when to buy certain stocks, you also need to know when to sell them. It's like when people come at me and say, what stock should I buy? Well, even if I was able to tell you, which I'm not a financial advisor, so I would never do that. But even if I did and I was a financial advisor, I would still have to tell you when to sell that stock. The problem is not with pies itself, it's how people are treating these pies. They're being treated as index funds where you just set it and forget it. Well, these are not like index funds. The thing with index funds, guys, is that the stock allocation actually updates based on a certain set of rules dedicated to that index fund, and this can be done on a quarterly or even a more regular basis. This is what I like to call true passive investing. As the index fund is updated on Vanguard or whatever the platform you're using, it updates for everybody, so it gives you the opportunity to buy as everybody else. With investment pies, this is simply not the case, because a person can set up a strategy today, buy a list of stocks, and then tomorrow he might change his mind and think, these stocks are not going anywhere. He might sell them all. But if you had bought on the day before, you would not have the updated version. You literally might have to even sell all those stocks again and then hit the copy button again to get the updated version. This is probably the only way you can get the proper updates for the allocation. Now, I understand that Trading212 also have launched very recently notifications to actually update you on various pie changes. But the problem with this is that if a person is selling a stock, it is likely for a specific reason. There's probably some significant news around the company. And with that in mind, it is likely that other people around the world are doing the same thing to that stock. And if you're not in the market at that time, you might not even get the best price when you're selling, because a lot of people might have sold off that stock way before shooting the price low. It can be very difficult to be reactive to stock changes, especially when you have 50 odd stocks in your pie. The second problem with pies is the way they are searched and the way they are placed. They are actually ranked by the number of views, not even by the number of copiers to that pie. It's literally whoever has the most views. I'm actually afraid for the newbies investors because this might mislead them. Remember guys, the best marketed investments don't actually equate to the best investments in terms of growth and appreciation. Even the most copied ones do not actually equate to the best investment. I've seen these investment pies where 6,000 people are copying it, 9,000 people are copying it, and I just do believe that in certain occasions people are just copying because other people are as well. And I do believe that especially new investors need to actually take a step back and think, am I investing in the pie? Am I copying it just because other people are? Or is there some value I'm going to get out of it? Remember guys, the worst thing you can do is have the fear of missing out, taking over your strategies in terms of your trades. And there is certain academic research even done to support this herd mentality claim. I think, some people are going, if 9,000 people are copying a certain pie, I might as well copy it as well. What's the worst that can happen? And that sort of mentality may be costly in the long term. In the UK especially, there's been many cases whereby this herd mentality thing has actually cost people a lot of money. And there's the obvious case of Neil Woodford's Equity Income Fund, which was, back in 2019, it folded. This was essentially an active management fund set up to manage people's investment. A lot of people lost money in this fund. At the peak, it had around £10 billion invested in the income equity fund. I believe that a lot of people invested in this fund because one, the brand name behind Neil and the fact that other people were investing in the fund. They didn't want to have that fear of missing out, which is what we're seeing today as well. Just because a fund has a lot of money under management and a lot of people invested in it does not mean it is the best course of action for you. Neil's fund eventually closed after a string of bad investments, and a lot of people lost a lot of money. The next thing people don't get right about these investment pies is over diversification. Yes, we know there's a huge benefit of diversifying your portfolio. If one set of stocks is doing badly, then the idea of diversification is to balance out your risk evenly, so your portfolio does not see peaks and downturns as impactful. However, you can pretty much ruin the benefits of diversification by spreading yourself too thin. By spreading your money across many different asset classes, you are limiting the upside that someone can deliver. Some people are using these investment pies to invest in a high volume of stocks every single month. They need to realize that although every single stock added may lower their risk, it also lowers their potential gain overall. There's actually little difference between owning, let's say, 20 stocks versus 1,000 stocks in terms of risk. The benefit of risk reduction and diversification become very minimal along a certain point. And there is actually data or research to back this up. Data from the Institute of Banking Finance's website shows that just owning 20 different stocks eliminates risk reduction by 56%. And adding stocks after this amount does limit the risk reduction by a minimal amount each time. The data actually shows that adding 200, 500, 1,000 stocks in your portfolio actually just evens your risk out to 61% each time. So really, there's very little difference. By the way, guys, do drop me a like if you're learning something new and subscribe if you want more videos like this. Anyway, let's get back into it. In my opinion and in my experience, adding way too many stocks in your portfolio just eats up your potential profits that can be made. There's a nice Warren Buffett quote that I like to look at when I'm thinking about diversification. According to Warren Buffett, wide diversification is required when investors do not know what they are doing. If you diversify too much, you might not lose a lot, but you certainly might not even gain that much either. Now, of course, this isn't the fault of Trading212 or investment pies, but it's about how to actually use the tools we are given. The next thing about investment pies I don't really like is the lack of information that is given with each pie. Yes, there is a section for pie authors to write down a set of descriptions for the investment pie to describe what it is about. But more often than not, I've just seen people just countless times just promoting their social media or promoting other pies to get them more views. I don't know what sort of benefit they get from that, but that's how it is. Of course, it's the person's own responsibility to go ahead and analyze those stocks that they're investing in. But sometimes this can do more harm than good, especially for newbie investors who are just getting started. I mean, we all were in that place before. Ultimately, pies can be a great way for investors to use their strategies to full effect. But I think people do need to be a bit more careful in terms of how they use investment pies going forward. Guys, remember to subscribe to my newsletter if you want more regular updates on investment pies, investment features, or any other financial news that I think that is worth sharing. Aside from that, guys, make sure you like and subscribe, and I'll see you in the next video. Thank you so much for watching.